Slowing economic data and trade tensions once again being reflected in the bond market, and the inverted yield curve, which is, of course, a classic cautionary sign for market watchers, looks to be raising its head once again. Steve Liesman is here. He's got an explanation of what he thinks is happening. Hey, Steve.
Morning, Becky. A yield curve inversion, that's when short-dated treasuries yield less than long-dated treasuries. It's supposed to be the other way around. Pretty consistent recession indicator. Take a look here. You can see the line, the grayed out parts, those are recessions, and it goes negative before each of the past three. And this is the 10-year to Fed funds. We are not quite there yet, or 10-year to 3-month either way. We're not quite there yet. A little bit left to go. UBS pointing out this morning that inversions ahead of recessions usually come along with tightening of credit standards at banks. That has not happened yet. Its credit recession model not flashing red, saying the recent yield curve inversion has been short-lived and may prove a false signal, as our recession model suggests. UBS says low policy rates around the world and global QE make the yield curve signal, get this, different this time. Still, markets have boosted their call for the Fed to cut rates. Take a look at these probabilities. I go away on vacation, they're much lower. I come back, take a day off, 58%. That's, pretty strong certainty about that happening in the fall. October 69 and darn near certain. December 85%. January a 95% probability of a rate cut. Any move in the bond market, I think this is important. First about inflation and the Fed before it's about growth. Bond traders get paid to get inflation right. They don't get paid to get growth right. And so it's interesting that with lots of concern about the trade war, investors have chosen to treat the raising of prices through tariffs as deflationary or disinflationary. That has been a fascinating development.